Crypto doesn't care how hard you try. It's player versus player. It's the heavy institutions with all of their knowledge, all of their capital, all of their infrastructure versus the regular Joe. Now, every quarter we get an insightful report published by Coinbase plus Glassnode that will give us an idea of what are the institutions doing versus what is regular retail doing. Here is that report. A link to it will be below this video as well. Coinbase plus Glassnode charting crypto in Q1 2026. For example, there are interesting survey results. In the last 3 months, both institutions and non-institutions have increased their risk exposure to crypto to similar degrees. So that's 14 percentage points for non-institutions, 15 percentage points for the institutions. In general, institutions tend to be a bit less risky. Both regard the macro environment as the greatest risk, and both expect Bitcoin dominance to go up. In other words, Bitcoin outperforming most other assets. That conviction has even increased in the last few months. So it seems like this becomes a more popular narrative that Bitcoin really is king. This is also the rising Bitcoin dominance is also one of the major ways how we make money on this channel, right? We bet on falling prices of altcoins versus rising prices of Bitcoin. Bitcoin is regarded as undervalued. The institutions here are in blue, the non-institutions in gray. So institutions like Bitcoin more than the average investor. And they also have a stronger opinion about the altcoins, that they're very unlikely going to outperform. The regular Joe is still more optimistic, which I find very fascinating given how many small retail investors got completely wrecked with these smaller altcoins. Right? Many small altcoins in the last year fell by 60, 70, even up to 80 and 90%. Still, the smaller investors are more bullish about the small altcoins than institutions are. And here's something interesting. What would you do if crypto was about to fall another 10%? The majority, both for institutions and non-institutions, would either do nothing or buy the dip. They're not anticipating selling at all. So this is good, right? In case we do go down, we might see some more buying pressure, which will be dominated by non-institutions, at least if the responses that were given in that survey will then translate into actions. Now, in the last year, crypto has underperformed most other risk-on assets, for example, technology stocks. I think one of the reasons for that is that people still trade the 4-year cycle. So the idea that crypto goes up for 3 years to then come down another year, to then go up 3 years, to then come down another year, that 4-year cycle is generated by Bitcoin's inflation schedule. That's a popular narrative. And when something is popular, it can become a self-fulfilling prophecy. What we see over here, again, this is from the Glassnode institutional report. It's the performance since cycle bottoms. The very first cycle from 2011 to 2025 brought the highest returns, a 500x return for Bitcoin. The subsequent cycle from 2015 to 2018 peaked at a 100x. So that's when Bitcoin moved from $200 to $20,000. The next cycle from 2018 to 2022 peaked at around 20x already. So we can see the diminishing returns. Those circles, by the way, is what I drew into this chart. And here now we've got the current cycle since 2022. And it might have peaked already at roughly 7x. And this is maybe why people are selling, right? The timing outside of the very first cycle, the timing aligns very, very well. We tend to peak after 3 years, and then we see a year of suffering. And this would not necessarily tell a great story for the next months. And so it's interesting how many people say that they would buy the dip potentially if we fall another 10%. On the other hand, we did see a lot of profit taking just according to the cycle theory. If the masses were to follow the cycle theory, it would not make much sense to buy after a 10% drop. Now, nobody can predict the future, right? We always try to just figure out what's going on with the data, what's most likely going to happen according to psychology, according to what other people are doing. Now, because we don't know what's going to happen, it's always good to be somewhat diversified. The best way to be diversified is to buy assets that have very little correlation to one another. So when one thing goes up, the other thing does not necessarily go up and vice versa. So the connection between the two assets is not completely one. There are potentially market cycles where the assets move in opposite directions. That's how we reduce overall volatility in a portfolio. This is how our portfolio does not go up 10x to then crash again 95%. We can reduce the volatility by buying non-correlated assets, by buying assets that don't move in the same direction at the same time. And this correlation matrix here shows what assets tend to move in the same direction and thus are not necessarily a great diversifier. Have a look at Bitcoin, Ethereum and Solana. Their correlation coefficients are very close to 1. That means they move in the same direction at the same time. There's very little diversification benefit from buying all of them. So it's better to just decide, do you currently like Bitcoin more, or Ethereum more, or Solana more? Owning all of them will not reduce your portfolio volatility. You will not really spread your risk. However, when you look at the correlation between Bitcoin and the S&P 500, while it's not negative, it's at least not that close to 1. So there is some diversification benefit by buying stocks and crypto, by holding both in a portfolio. A better diversifier even is gold. Now, gold is not necessarily very cheap. It has gained a lot in the last 12 months, but still, just in terms of diversification, right, a number close to 0 means very little correlation. It's quite good of an addition to a portfolio. Gold and silver both have little correlation to Bitcoin or to any crypto asset for that matter. The dollar strength, interestingly enough, right, the DXY, also has very little correlation with Bitcoin. Some people say that the dollar strength has some connection with where Bitcoin might be going. This correlation matrix tells a different story. Now, since you are still watching, you are the kind of person that this channel is made for, so feel free to subscribe over here. I publish videos regularly. On the right side, we see the correlation coefficient over time. So Bitcoin versus the S&P 500, that's the blue line. It tends to hover at around 0.4. And in gray, we see the correlation coefficient of Bitcoin versus gold, which tends to hover around 0. So really, gold is the better diversifier. On the left side, by the way, we see the volatility. So the volatility, or the price risk, the magnitude of how much prices are going up and down, is declining over time. That's true for all crypto assets. When comparing the different cryptos, of course, Bitcoin is the least volatile and Solana is the most volatile. Now, while the prices of Bitcoin and gold aren't necessarily correlated, they move in different directions, the two assets do have similarities. For example, it's very hard to value them. For property or for stocks, it's relatively easy to value them because we just look at the future cash flows and we then put them back to the present here. So we make NPV calculations, net present value calculations. We can't do this with gold, we can't do this with Bitcoin. With gold and Bitcoin, we just have to look at psychological markers, right? What is currently the net unrealized profit versus net unrealized losses? Are people likely going to take profit? Are people likely going to realize losses? What's currently the anchor point of the market? And we've got a metric for that in Bitcoin. It's the NUPL, the net unrealized profit and loss. When it's very high, then there's a lot of net unrealized profit that might get realized, and then profit realization means falling prices. People get out of the system. However, when the market on average is in losses, right, so that's here in this gray area, then the sell pressure might decline, because if you're still long-term bullish on Bitcoin, if you still think they will appreciate versus the US dollar, why not simply just continue holding until prices recover? Now, that's a chart that's given by the report. I prefer this representation of the same metric. It shows us a bit more history, and those two lines also give us an idea of how the trading range might be changing over time. So people are buying up bottoms when the market is depressed a bit earlier. They're also taking profit a bit earlier. Again, a reflection of how volatility or price risk is declining over time. Unfortunately, the market is currently not in net unrealized loss. Otherwise, we'd be at very cheap prices, and it might make sense to get back into Bitcoin. It looks like since Bitcoin hit 70K, that the net unrealized profit tends to rather decline. The price is still going up, but the profit taking is quicker than the price appreciation. And so that anchor point, right, where is currently the average price of the market? That's called the realized price. At what point will net unrealized profit turn into net unrealized losses? When does it make sense to buy against the momentum? When does it make sense to be a contrarian? Here's a chart by the report, but I like this chart more. Again, it shows us a longer history. What's currently the realized price? The answer is $56,000 roughly. So below $56,000, we are at historically low prices. At least in the past, that's when bear markets tended to end. If 125k was the peak in Bitcoin, then we might bottom out close to 56k. Now there's a modified version of this metric, and that's the long-term holder realized price. That tends to adjust a bit later, and we also tended to fall below that price level at the end of a bear market. Now since that adjustment takes more time, that realized price is currently closer to 40k. So there's really still quite a bit of risk in Bitcoin, more risk than most people realize. There is a misconception that it's Wall Street that currently has all the power over Bitcoin's price, that Larry Fink accumulated enough Bitcoin to move Bitcoin up or down, but really it's the long-term holders that have all the impact. The ETFs only hold roughly 6% of the supply, so do the treasury companies, so really close to 90% of the supply is still in the hands of all the other people. And the vast majority of Bitcoin is not just in short-term speculative hands, it's in long-term holder hands. There is a chart in the report about this as well. We can see how the long-term holders took profit at price peaks and how that profit taking tended to stop. But this chart shows a lot of smoothing of the data. It's just an average value. A more precise chart is this one over here. It comes from checkonchain.com, and it also shows us how things have turned around. The long-term holders are now starting to slowly accumulate again. Not aggressively, but they are buying a bit, and that's very good, because in the past when they bought, it showed how the current correction turned around and how it could repair for another rally. Unfortunately, they aren't yet buying that aggressively, but we have to watch this metric very, very closely. Again, it's available on checkonchain.com for free. I will of course also make updates around this metric regularly over here on this channel. So feel free to subscribe in case you haven't yet. Let's have a look at Ethereum. It trades very similarly to Bitcoin, as in when the average Ethereum holder is in losses, we tend to bottom out. We are currently not yet in losses. The realized price is close to $2,400. And the reason why we saw lackluster price development over the last 2 to 3 years was selling by the long-term holders. So you see at the top, that's the ETH supply that has not been moved for the last year. That tended to go down. In other words, the longer-term holders tended to start moving their Ethereum in order to sell it. I think the picture is very much mixed, because according to cycle theory, we should rather see a bearish 2026, but we do see first purchases by the long-term holders that tended to buy the bottoms throughout the current bullish run, right, from 16k all the way up to 125k. We had our 20 to 30% corrections, the same thing we've got now, and we tended to come out of those corrections because the long-term holders were buying, and they are buying right now. Not very quickly, but at least they're starting with it. I strongly believe it makes sense to be diversified beyond crypto, because there are opportunities where still we have positive expected returns, but very little correlation to crypto. So just in order to reduce overall portfolio risk, it makes sense to own more than just Bitcoin. When does it make sense to be overexposed to crypto again, to have maybe more than usual? It's when we are below the realized price. And in the worst case, Bitcoin could fall all the way down to 40k. So we have to have some kind of risk mitigation. Either we don't have that much exposure and it's okay for us if Bitcoin falls to 40k, or if you've got a lot of exposure, then there needs to be another risk mitigation tool. Something like using stop losses, for example, and then reducing exposure and only buying more once we're really, really low. So I believe it does make sense to think in terms of scenarios, because nobody knows what's going to happen. What are you going to do in case Bitcoin rallies from here? What are you going to do in case Bitcoin drops from here? And what are you going to do in case we enter a real bear market and we drop by, say, 70 or 80% from the all-time high? If you're not mentally prepared for such a scenario, then once that scenario hits, you're probably not going to act the right way. If you got some value out of this video, feel free to give this a like. Feel free to also check out the premium membership. This is where I share my own trades. This is also where you can co-invest with me. So whatever trade I make, you can then automatically copy trade. That's all in premium. Just click on the link. There's more information on that website. Thanks again for watching. See you next time on YouTube or in premium. Cheers.